Nothing in life is free, and that's certainly true when it comes to investing your hard-earned money into the stock market. Whether those fees are taken up front, monthly, or hidden in the background somewhere, there's money being made when you place a trade to invest in your favourite coffee company or a global index fund. The most important thing about fees and charges in investing is understanding what something is really costing you, so you'll fully understand what you're getting yourself into, and also how you might be able to reduce those fees or even remove them. As you'll learn in today's video, fees and charges can significantly add up over time, which all eats into your overall profits and can even add up into thousands and even hundreds of thousands over the long term. I'll run through all of the various charges and fees to look out for in the investing world, whether that be trading fees, account fees, exchange rate fees, and stamp duty. I'll provide real life examples on some of the platforms that I use myself, and then by the end of the video, you'll be in a much better place to start making your investment choices and know what to look out for. I'll also throw in my top tips toward the end too. Right then, let's start from the beginning and work our way through all of the different charges that we might expect to see across some trading platforms in the UK. First up, let's deal with trading fees, sometimes referred to as commission. This is charged when you buy a share in a company or an ETF, an exchange traded fund. I'm also going to talk about something here called the spread here too, as this is another way of being charged for the trade without explicitly telling you that it's a cost. The majority of platforms charge you a flat fee of making a trade, regardless of whether that be £100 or £10,000. The fee remains the same. Trading fees range from free, but we will deal with those in a moment, to £11.95 per trade. Those fees apply to shares, ETFs, trusts, gilts and bonds, but typically do not apply to mutual funds. For some examples, Hargreaves Lansdown charges a trading fee of £11.95, AJ Bell charged £9.95, and Barclays Smart Investor charges £6. Now, some platforms do not charge trading fees and commission, but it's really important to know that there's still money being made, and this is often made in what is called the spread, the difference between the buy and the sell price. For example, let's say the share price of a company is exactly £1. Rather than charge you an upfront fee of £10 to make the trade, this platform says they're free and don't have any commissions. But in reality, they make a small profit in the buy and the sell price. The £1 share price might end up costing you £1.04 to buy and 98p to sell, or something similar. While this is a welcome move in the industry and encourages more people to get started investing, you still need to watch out for this if you're a frequent trader, as you're not necessarily getting the best deal on your trade. Platforms that have no commission and no trading fees include newer brokers like Trading 212, Freetrade and eToro, but Trading 212 and eToro make a lot of their money from the CFD trading side of their business, where the vast majority of people lose money. Just be careful out there and make sure you fully know what you're getting yourself into. CFDs are incredibly powerful and you can actually lose a lot more money than you put in. Next up, let's look at platform fees or account fees. As the name suggests, these will be fees which are typically charged monthly for the pleasure of holding an account with your broker. Some account fees are charged based on the amount you have invested and what you have your money invested in, or even just a fixed monthly charge. These fees are typically a low percentage or small amounts of money, but be aware that they can very easily add up over time. For some real life examples, Hargreaves Lansdown, who I use for my SIP and ISA and general investing account, charge 0.45% account fee, which is either limited to £45 to £200 a year, depending on what you have invested in and which account you use. Whereas platforms like Interactive Investor has a fixed monthly fee, which does not change based on how much you have. Others even have no cost at all, or offer an optional premium service like Freetrade, for example. By paying their account fee of £3 a month, you can utilize an ISA, or £9.99 to get a premium version which offers additional features, unlocks more shares to purchase, and the ability to open up a self-invested personal pension. Next up, let's talk briefly about exchange fees or FX fees. As you might expect, if you want to buy your favorite US tech stock, which is traded in US dollars, you'll always need to change your pounds to do this, whether all at once or per trade. And because it's percentage based, it will only climb the more of the stock you buy. What this means in reality is that in order to make a profit on the trade, you'll need to hope that your chosen share increases in price by at least 0.5% in order for you to make a profit. One platform which I quite like, which does things slightly differently to the rest, is called Stake. They offer a platform to trade only US shares and have one-time FX fee at the point of deposit or withdrawal only. So once you've got your money in the platform, you're free to trade in and out of US stocks with no other fees until you decide to cash out and send pounds back to your bank account. Otherwise, this is just another fee to be aware of, so look out for this one. Next up, stamp duty. This is one where there's no getting around from, and I'm afraid this is a fixed 0.5% charged every time when you buy a UK share. It's not a huge sum of money, and it is just when you buy the share, not when you sell it. To be clear, it's just on UK listed shares and will not apply to any US stocks or any other overseas companies who you might invest into, listed on other exchanges like the Nasdaq, Dow Jones or others. Next up, these are my final two kind of fees we need to look at, but they're also some of the most important to understand. These costs are known as ongoing costs and transaction fees, which will only apply when you own ETFs or other trusts or mutual funds. When you buy into a fund, whether it's passively managed or actively managed, you'll have to pay the managing company a fee to keep the fund alive for you. These ongoing costs can be both relatively small and cheap, or they can be quite expensive, and are some of the most lucrative ways that fund managers make their money over the long run. Regardless of how well their fund performs, they will still get their money. Let's look at a couple of different examples to see how the ongoing costs might look for a passive fund and an active fund to get an idea of what we're talking about. Bear in mind too that fees are typically taken from you monthly or quarterly, depending on who your broker is. So make sure you have cash in your account to pay for it, or set up a direct debit to take care of fees where it allows. First up, let's look at a low-cost index fund from Vanguard, the all-world UCITS ETF, which trades under the ticker symbol VWRL. The ongoing cost of this fund is 0.22% per year, and you can find this by looking at their website or also looking on your broker's platform. In this example, I'm on the Vanguard website directly. So for every £1,000 we have in this fund, each year we'll be charged with £22. In the grand scheme of things, this is a small amount of money, but still worth being aware of. For an actively managed fund, something like the Bailey Gifford American Fund is a good example to use, and I'll take this information from Hargreaves Lansdown's website to see how much their ongoing costs are. For this fund, you'll be looking at 0.31% charge, so as you can see, this cost will be slightly more than Vanguard Fund, as it's actively managed, so the fund managers are choosing which stocks to include in the fund. Just a word of caution though, there are some hidden fees along the way here, which are not openly listed, which include transaction costs and one-off costs, which will affect your investments. They are not always transparent and you have to dig around for these. As an example, on the Vanguard website, you can only find these by downloading a complex looking PDF, and it shows how the VWL fund actually has charges totaling 0.29% once you add up the transaction costs and one-off costs. So this is another 0.07% charge on top of that 0.22% that is listed on the site. And that brings us to my top tips after investing across lots of different platforms for many years, and I'm always still trying to optimize my investments to save money and generate the best returns. Firstly, I'd say that work out first what you actually want to invest in, what type of account you'll be using, and then work backwards from there. So for example, let's say you want to just invest in low-cost index funds, mainly in a stocks and shares ISA, and then have a small account for individual shares. Choose the fund you're going to invest in and run the numbers for each platform to see what will work best for you, and then do the exact same with the individual shares and find out which platform will allow you to trade them and at what cost. Do not be afraid to have multiple platforms. I think there's no benefit of having all of your assets in one place if you're not going to be rewarded for it. So why not have a stocks and shares ISA with Vanguard, trade some UK stocks on Freetrade, and then have some US stocks on Stake? There is nothing wrong with doing that, and it might be the most cost-efficient way of running things. Personally, I use Hargreaves Lansdown, Vanguard, Freetrade, and Stake for all of my investments currently outside of cryptocurrency, which includes then another several platforms. Diversify and make the most of the different platforms, I say. Not everything investing is driven by the costs, but it should play a big part in your decision making, as over the long term, they do and can add up into a significant chunk of money. A single percentage point can have a huge impact on what you might end up with in 20 or 30 years' time, which could knock off years to an early retirement or getting that Porsche you've always wanted. Anyway, remember that I'm not in any way a qualified financial advisor. I'm just here sharing my experiences. Please make sure you do all of your own research and look after yourself out there and do what's right for you. Anyway, thank you so much for watching the video. If you found it useful, please drop me a big fat like. Subscribe if you aren't already for many, many more videos. I will see you guys in the next one. And as always, happy investing.